We'll get started. Thanks everyone for joining. We have Henry Byrne here from Transurban. Very exciting news overnight with your announcement of an appointment to CFO. So congratulations. Hope you had a chance to celebrate, or you will have a chance in the next week or so.
Not yet.
No. Not yet. Okay. Fraser, we'll figure something out after this. Given the panel topic of future of transportation, maybe let's start there before getting into the company. On the last earnings call, management outlined some of the big picture drivers that I thought were interesting: urbanization, electrification, mobility as a service. So maybe we can check off each of those because those sound like a good place to start. Urbanization, one of the most interesting parts of the Transurban story is the immigration patterns into Australia and specifically into the network itself. Maybe we could give some color around how you think about the benefit of that within the system and your expectations for traffic going forward.
Yeah, well, urbanisation, I guess the main thing you're looking at there is population growth, which is one of the critical drivers, obviously, in how the network traffic then evolves over time. And we look through the kind of noise of the near term to the longer run trends, sort of in parallel with the timeframes around our concessions. So in all of our cities that we operate, we're looking out to a sort of 2040 timeframe, trying to understand what kind of population growth characteristics we're going to see in those markets. And I think for those of you who've seen the material we put out, it's a pretty strong tailwind for the business looking out over a couple of decades. So anywhere from 15 to 40% growth, depending on which city you're looking at within our portfolio. Of course, that gives a kind of broader sense of the growth that underpins traffic from a demographic perspective. To get down to the individual assets, you've got to understand the cities a little bit more because they do vary depending on use within the cities. But it's a very, very supportive trend, I guess, for the business looking at it a longer term.
Yeah, and very unusual to the network, and certainly a big benefit versus other toll roads.
Yeah, it's a big part of why we go to certain cities. So you would have heard us speak about urbanised environments. We don't run interurban networks the way some of the comparators do in Europe. We're intra-city, and we look pretty carefully at the demographic characteristics around the cities we're in before we would ever think about going to a new one. And so you'll see pretty common characteristics in the places that we operate.
Yeah. How about the second piece, electric vehicle and eventually autonomous vehicle? Certainly that would change the flow of traffic meaningfully and how you think about speed and safety. What are the investment opportunities when you put on your hat for the next 10, 20 years as an investment that we should be thinking about?
Yeah, there's a couple of dimensions to that. I tend to separate EVs and autonomous vehicles. People often throw them in together, but there's a few different things going on there. So EVs play out for us more in terms of changing the character or quality of our business, making us effectively a more sustainable proposition. So whether we like it or not, we're thrown into a bucket with transport stocks seem to be a part of the carbon problem. And so if you think about what will happen with the vehicle fleet and electrification that we're all expecting, it's going to be another tailwind in a different kind of sense, in a more thematic sense, in terms of greening us up a little bit. And then I think it's a brave person who estimates exactly what the EV uptake curve or whatever kind of low emission sort of energy source we're talking about. It's in a state of flux at the moment. So we're seeing some pretty radical revisions to what we thought the curve looked like, which probably means it's going to accelerate more quickly than we thought. So we're definitely going to benefit from that as a business. And we're doing a bunch of things ourselves to try and sort of help that along a little bit, albeit I wouldn't want to overstate that. We're probably playing a little bit more at the margins. Others are sort of driving, and governments are really the ultimate driver there. Autonomy is very interesting for us, and it's one of those things we look at as a near adjacency where we think we can find ways to exploit a competitive advantage we have within the current core business to drive a sort of value-added layer within the core, and then also think about new business development. So there's a lot going on with it at the moment. We're moving pretty quickly to shore up some partnerships and start to sort of work out where the infrastructure sits in the kind of value chain there, but it's clear the infrastructure is more front and center than people were thinking. And so we're finding that we're getting a pretty good audience with some pretty key players.
That's interesting. Interesting story a month ago coming out of San Francisco music festival. 10 autonomous vehicles got stuck because they couldn't connect to the cloud. Kind of got me thinking, is there opportunity to invest in connectivity and 5G small cell along toll road assets, or is that sort of sit outside of the investment opportunity?
No, there absolutely is. Whether I don't know specifically in terms of what the technology looks like, but what's happened with autonomous vehicles is, I'll say 5 years ago, I've sort of made that time frame up a little bit, but a number of years ago, people were talking about solving the autonomous challenge in the vehicle and in the cloud, and it was, at the time, there were some pretty major pronouncements from some prominent global players like Elon Musk saying it was close. It's clear it's not that close when you talk about ubiquitous application of automation into the passenger car fleet. But what is closer than people thought is probably the application of autonomy in freight, in sort of high value, very targeted use cases, point-to-point ports to inland ports. And the thing that's making that more of a commercial reality is the infrastructure. So what we've found is that we were right at the margins of automation, and the discussion around automation 5 years ago, we're now front and center, and we've just signed a partnership with a Silicon Valley company, Plus AI, who are going to work with us in Melbourne, which is our sort of headquartered home market. And we think we're probably going to be at the forefront of how this thing rolls out, and it will happen on our networks, connecting ports to sort of inland logistics facilities and distribution centers.
Yeah. And then the traffic dynamics, you think of that last piece, the mobility as a service, car sharing, public transport, all these other items. How would that eventually sort of feed through into traffic or the flow on the network, you think?
Yeah, well, car sharing, maybe bucket car sharing and MAS, and there's a sort of fairly amorphous kind of discussion that sits in around all of that. Look, the house view we've always put forward on that, and certainly how we reflected in our long run modelling, is that volumes don't change a lot around it. If anything, there's probably a marginal benefit. Car sharing, the real shifts happen, that actually is quite tied to autonomy, we think. So you'll see a shift around probably vehicle ownership. So it'll move away from the asset intensive, sort of capital intensive owning of an expensive vehicle to probably more of a service type offering, certainly for segments of the community. And so you'll see fewer cars on the road, but the trips and the volumes probably won't change. If anything, we think they'll increase.
Interesting. Yeah.
That's certainly how we're thinking about it at the moment. Of course, we're guessing like everyone else. So I wouldn't. It's a brave person who says they actually know exactly how it's going to play out. But but it's a net positive in our minds, certainly.
If you kind of pull forward to the next few years, there was a comment on the call as well around, given a choice between public and private transport in the network, currently consumers are still sort of deciding to go with their private vehicle instead of using public transport. Is that a structural change here, you think, just post-COVID, or will that mix shift actually move back towards public transport?
It definitely has shifted from COVID, and that was the first time we'd ever seen that. A kind of traditionally, you didn't see people move out of public transport you didn't see people move out of private cars onto public transport, even when links were built near them. You saw people mode shift between public transport options, and if they were car users, they'd stay car users. We saw a lot of people come off public transport for obvious reasons, the public health issues associated with COVID, and they haven't gone back. So I think public transport's still 20 to 30% down on where it was pre-COVID in terms of volumes. We're sort of almost back at pre-COVID levels, not quite. So it's that theme hasn't quite unwound, but we do think it's going to unwind more than it has. So there'll be a kind of mean reversion. When we talked to our traffic team about sort of where we're at on the COVID recovery curve and have things locked or set, they're still quite resistant to the idea that we're kind of in a new normal and we can see what it looks like. They'd say we're still in a state of flux and things are still going to continue to evolve even in the next sort of 12 to 24 months. So I don't think, I think you'll probably see things approximate back to a kind of pre-COVID environment, to be honest.
Yeah, it's just a slow trend back, I
Exactly.
suppose. Yeah.
Yeah.
So maybe we move to investment opportunities for the company. Recent announcement from the ACCC around Eastlink. I don't know. I know there's a press release around potential options for Transurban. We could start there, and then we can talk about other opportunities if you have any thoughts on the next steps with that asset.
Well, Eastlink's obviously the latest news is pretty new. We got the determination out of the ACCC last week, so I had a team who was working on that opportunity, and it was obviously disappointing. You would have seen from our response, we have a pretty clear view that there's not a lessening of competition. We had probably unusually black and white legal advice supporting that as well. So at the moment, I think there's not a lot more that I'd be willing to say other than we're looking at our options, but you can imagine what they look like.
Okay. Other investment opportunities potentially outside of that asset, where are you sort of spending your time, or in the company spending time in terms of inorganic and organic growth?
We're very focused within our existing network still. So we've been saying that for a long time, and it's for no other reason than there's still a huge amount of opportunity that sits within them. So governments are still talking about a significant number of projects on all of our networks, either privatisation of existing assets that they're currently building, or new developments that need to be done in time. But it runs into the tens of billions in terms of what we would expect. And that's just an easier place to play. We know it. We have the relationships. It's a safe place for us to deploy capital. We will look at new markets, but it's a high hurdle for us to clear for the reasons I was saying earlier around demographic characteristics and probably more importantly, competitive advantage. We need to be confident we're bringing competitive advantage to the table if we're going to play in a new market. And that's looking at things like our operational capability and our development capability, principally, probably increasingly the innovation and tech thing will start to play into it a little bit more. And I suspect that might be one of the factors as we look out over the medium to longer term that opens up a bit of a new growth leg in terms of where we can go and why we can go, bringing competitive advantage if we're able to kind of follow through on this promise that I'm describing around leading the world in the application of what is quite an exciting technology. That's certainly something we're looking at. But in the near term, I don't think you're going to see us pop up in Europe, or we'll always look in North America, but in quite a targeted way, and probably start with our existing footprint in the Greater Washington area in particular, and Montreal, and kind of work out from there.
Okay. For assets that you have looked at, I suppose, does it feel like valuations have actually reset to reflect higher cost of capital now, you think, or are we still waiting for better entry points for some of these assets?
Well, in our space, they're always pretty competitively bid, to be honest. Long dated inflation protected cash flows are pretty sought after. So I don't, notwithstanding some of the broader commentary, particularly last week around Eastlink, there's never a shortage of competition when these things kind of come to market. There was probably a little bit of a pause as people were understanding the thing you were questioning me on earlier around where we've gotten to in the recovery, were these things kind of irreversibly altered as a result of the kind of shifts that happened around COVID. And I think the jury's in on that to say no. They've kind of resumed, and you would have seen we're back on our distribution pathway that we were previously. We're pretty confident in terms of where the long run traffic trends get to. So that says sort of valuation parameters at their fundamental level are pretty constant. In terms of sort of what's happening with monetary policy and how that flows through to discount rate, cost of capital kind of assumptions, we've always looked through the cycle on that anyway. So we didn't take much on the way down, and so we don't need to adjust much on the way up, which means things are sort of largely constant. I have seen partners who probably had to adjust up return expectations a little bit from where they were. But in terms of we sit within the business, it's pretty stable, to be honest.
So your own internal hurdle rates have largely stayed
largely.
Yeah, interesting. Given that we're in the U.S., there was an announcement earlier in the year about some of the Maryland assets and stepping away. Maybe you could touch on the rationale there and how much of it was sort of local asset dynamics versus cost of capital versus cost inflation. What was sort of the backstory there, and how do you think about that?
Well, North America, and when I say North America, I'm really talking about DC and Virginia, and Northern Virginia in particular. Although that was obviously Maryland, but things have always taken a little longer in terms of just getting through the various sort of approvals and regulatory processes to get a project from conception to kind of opening in North America, and by longer I mean years. And we've seen that in all of the pieces of network that we've developed out so far. And one of the challenges is then just the amount of challenge that can be brought from various quarters as you're taking it through this lengthy process. So that's essentially what happened here with the Maryland opportunity. Effectively one of the environmental approvals was just being held up through challenge, and we got to a point where we had to put something forward with some certainty and we couldn't do it. And so we weren't willing to write a deal with that much uncertainty, so we had to walk away. It's something which we're going to have to continue to work on. I think we're in a reasonable shape with the Maryland government. So over time, I think we'd hope to open that market up again, to be honest.
Oh, interesting. Yeah.
For the time being, it's probably Northern Virginia there.
Yeah. How about other new markets in the US? I mean, I know each area, the Department of Transport is very unique, and each opportunity is very unique, but are there other opportunities to sort of step in and add to your asset base here?
Yeah, without being specific, there are, and when we say markets, it's really cities. You're kind of looking at individual cities and you're trying to understand all of the dimensions I was describing earlier. The one I probably haven't talked to is the regulatory dimensions and the political thematics. That's pretty important because you want governments that are kind of on board with the PPP model and understand how it can augment their ability to do things and build things out. The best example globally, I think, of that having happened is Sydney, where we've had, I think, $40+ billion in private capital go into just our sector in that city alone through the course of the past couple of decades, predominantly around our business or things that we've subsequently acquired. So there's a model there for people or governments who are bought into that idea about how you can leverage that for some pretty great outcomes for the city. And there are cities in North America that will make sense for us to look at more closely, but it's kind of numbered on one hand for us. We're not in 15 cities prospecting, trying to get in. We're working in pretty targeted ways where we think and ultimately it's around building out network positions. We're not interested in getting in to own a single asset and just run it for cash. We want to get in there to sort of leverage some of those competitive advantages I was describing earlier.
Yeah. I was thinking about the opportunity for urbanization, and your markets always tend to have that structural growth behind it, population growth. Anything in sort of emerging market, Latin America, for example, with those cities, would you have enough regulatory certainty, asset opportunity? Certainly the growth is there, but would any of that sort of hit the hurdles required to invest?
Look, we've never gotten close,
Yeah.
to be honest. I'd never say never because I don't want to pop up here at a future sort of conference having bought something somewhere, but it's never really been front and center in our thinking. And for the reasons you described, there's a big kind of hurdle to clear around the regulatory and political risk, I think, that you're dealing with in those economies. And the compact we had with our investor base is probably not quite there on that, to be honest. So we'd have a fair bit of work to do if we wanted to make a move like that.
Yeah. Okay. One more on the development side. A lot of investors are focused on both cost of capital, but cost inflation for development, for the assets currently under development, certainly in Australia. Maybe just touch on any concerns around inflation and how that impacts you both from the construction cost or materials side. Is that all largely locked in, or there's issue?
It's been a real issue. So you've seen it, and we've had challenges on our projects. Westgate Tunnel was the notable one, which had a very significant cost blow added on in Melbourne. So I was part of a group that kind of negotiated the kind of settlement with all the other parties on that one, and it was pretty painful, to be honest. There were some nuanced factors which I won't go into specifically around that, but one of the factors clearly at play at a macro level was cost inflation.
Yeah.
And how then the contractors were behaving in that kind of environment. Having been through that, I think we certainly as a business have tightened up quite a bit on that in terms of what we'll be willing to do at the moment. So I think it would take a bit for us to take on a major greenfield right now, and we want to be absolutely confident that we weren't going to find ourselves in a similar situation. Again, it's not to say we won't, but But I think our board would be making some pretty strident demands of us if we as a management group wanted to do that. There's some things we've been doing in terms of process, specifically around how we're sort of embarking on the process. So we have written some new business. We've got the M7, M12, which is a kind of multi-billion-dollar opportunity in Sydney that we're developing on our network there, which we wrote after the Westgate Tunnel issue. And I guess the things we're doing there are pretty obvious. So there's a bit more going into the design phase before you get into the build. So just running that to ground in a little bit more detail to put some more certainty around the design parameters that you're dealing with. Risk allocation is obviously one of the things that we're looking at. And we haven't thrown the sort of old model of risk allocation out the window, notwithstanding some builders' desires for us to move to a kind of cost-plus type model. But we are playing with, we've indexed some of the costs which have been a bit more volatile. So I think, there are some things we've been able to do just to tighten things up a little bit to get comfortable with the risk profile around those things.
Yeah. 10 minutes or so. Maybe I'll ask one quick one. I know for many investors, it's a big company holding, so I'm sure we'll have some audience questions. Just on sustainability, to wrap up, thinking about scope 1, scope 2 emissions and hitting net zero targets, it's certainly a topic for all companies, but it's not always a straight line. There's always going to be some additional technological changes or something else required. Maybe we could touch on how you think about that path to reducing both scope 1 and scope 2 emissions and any concerns you have reaching.
Yeah, well, scope 1 and 2, to be honest, aren't a major issue for us. So if I kind of plot out what our carbon footprint looks like, we've got currently about 50,000 tonnes annually of scope 1 and 2. That's come down from 200,000 a few years ago. So we've done quite a good job. We've already hit our 2030 targets comfortably. And I don't want to make too much of a virtue of that. That's renewable kind of energy agreements predominantly. But that we've sort of gotten there on scope 1 and 2. Scope 3, which is a little more tricky, that's the supply chain, getting into materials and the big builds, and predominantly there. That's working through coalitions with the builders effectively to get into circular materials, get into kind of some of the new low carbon materials, and that cemented steel predominantly is the big carbon emitters.
Yeah.
And so we're making progress there, but we're still about 450,000 tonnes of scope 3. So we've got a bit of work to do on that one because we've got a 2030 target that we've got to hit. And then the big one is, which actually isn't within any of our targets, is the customer emissions, which is about 1.2 million tonnes a year. And that kind of plays into that earlier discussion we were having around electrification of the vehicle fleet. There are things we do to help with that in terms of new design on projects as well. So there's a fair bit of work that goes into just thinking about how you can design assets in ways that reduces the carbon output from the tailpipe effectively. When you think about it, pretty obvious things like gradients on roads and tunnels in particular can make a big impact. And so all of the assets we're now building and bringing online get rated for their kind of future propensity to drive customer emissions on the roads as well. And we've made a bit of progress there, but we've got a fair bit of work to do, I think.
I was going to ask you on the materials side, just quickly, anything you can do in terms of incentivizing that supply chain to actually reduce their emissions, whether it's requiring a certain type of cement or steel or however you think about it, or is that sort of naturally going to happen on that side, you think?
No, you definitely can. It's all to do with targets, how you embed targets inside the contracts. You probably wouldn't even go down to the specificity of certain types of materials. What you would do is set carbon targets that they have to hit. And the implication is that they need to kind of move into certain practices or certain materials if they're going to get there. I think they're pretty motivated themselves, to be honest, as well, because they're being held to account in the same court of not just public opinion now. It's actually, it's kind of got more regulatory implications around it as well for businesses.
Yeah.
So it's a pretty motivated kind of group who are working towards it on all dimensions. I mean, it's not to say there's not a pretty significant challenge there with that scope 3 piece.
Right. Yeah. Maybe I'll open up for questions. Does anyone have a question? No.
You mentioned that you just do and then I guess the COVID experience was different in terms post-COVID or sort of traffic. So if you use that sort of code, is that sort of anomaly, that experience where you just
yeah, good. That is a good question. Sorry, I should have clarified. They are a bit different in terms of their risk return profiles around that express lane model. We still like it a lot. It sort of gives a little bit more diversity within our portfolio to some extent. So there's more upside and a little bit more downside, and they've taken longer to recover. So anyone who's looked at the latest numbers knows the express lanes are a little bit behind in terms of volumes. But they will get there for the same reasons I was describing earlier. When you look through the longer run trends in terms of where the demographics and population growth is going in these cities and where congestion levels are already kind of getting back towards, there's still a very strong value proposition that sits in behind them. So, you know, I think we're pretty confident, to be honest.
Anything else?
see see that was an attractive way of raising tax. Do you think that's a specific case from the side? Or is that something that worries you that government's increasingly other additional revenue streams that might happen elsewhere?
Yeah. As tempting as it is to cast aspersions on the French, it's probably a broader phenomenon that the industry just has to be cognizant of, to be honest. I mean, the French have always had a propensity. The French and Italians have intervened in the equivalent sort of businesses in their markets much more actively over the years. So I think we would say there is a lower political risk profile in the markets that we're in. And history has borne that out to some extent, but that doesn't mean there's not an ever-present risk that needs to be managed for a business like ours. We kind of use a slightly worn-out vernacular around social license on that to talk about, you know, what needs to be managed, and we've got very detailed strategies around that within the business that really go to just reinforcing the customer value proposition in meaningful ways. So you would have seen we kind of recut our corporate strategy statement a couple of years ago, and I've got to be careful trotting out the corporate strategy statement. It can be a bit trite at times, but there was a lot of thought that went into this in terms of thinking about where the competitive advantage sits, and some of it goes to answer your question. So we talked about understanding what matters to our stakeholders as the starting point, and really what we meant by that was a multitude of stakeholders beyond government and capital, which is where the businesses like ours have traditionally looked. So there's been much more a reweighting of focus to customers, communities in particular, also to sort of industry partners now as we kind of pursue some of the innovation piece, but the customers and the community piece is big. And Scott certainly started us on that journey over the past decade. We are a radically different business to the one I joined 16 years ago. We've strengthened the customer proposition in a whole range of different ways. And I know Michelle's looking at that meaningfully as we look forward. And it's with a view to managing risk firstly, and then probably pursuing opportunity on the back end once the risk is managed.
Any last one? We've got time for one more. No? Well, thank you. Thanks so much, and congratulations again.
Yeah, thank you.
Yeah, appreciate it. Great.